starting off. Thanks so much for joining in. We'll make this quick because this is just because it hit all-time highs today. I just thought it was important to get in some really cool guests to try and understand what is it that they are feeling, what is it that their clients might be feeling, what is it that their portfolios are doing. And it's an eclectic mix. We got a portfolio manager, we got a CEO of a sell-side firm, and we also have an expert with tons of experience who manages his personal portfolio. Ajay Bagga would be joining in sometime. So it's a good eclectic mix today. Gentlemen, Gurmeet, Rahul, both of you, thanks so much for joining in. Rahul, what were clients telling you, or what is it that you were telling clients today when we hit all-time highs? Are people comfortable staying invested, putting in more money to work currently?
Good evening, Neeraj. Thank you for having me on the show. Interestingly, Neeraj, the conversation over the last 1 week has actually been what to sell rather than what to buy. And I think that sort of, in a strange way, sums up, the kind of mood that there is. I think the fact that we've hit all-time highs is obviously a very joyous occasion. But, as the famous saying goes in the movie Spider-Man, with great power comes great responsibility. So I think, at this stage, exercising caution will be very, very important. And, it's becoming a little difficult, Neeraj, to justify stocks from a 1 year forward. So unfortunately, as sell-side analysts, you keep rolling over. And that's what our team has done as well. And I've seen most of the street do that. So while it's great that, we've hit all-time highs and things are looking euphoric, but it's becoming increasingly tougher to identify stocks to give you material returns from here. Also, Neeraj, bear in mind that, fixed deposit rates are rising. They've, some banks are almost at 7 quarters, 7.5. For senior citizens, it's inching to 8. For super senior citizens, they're north of 8, almost 8.25. So this becomes a direct competitor to the equity markets as well. So I think all things considered, great day, but I think it's best to exercise caution right now and just to accept the fact that money making from here, according to me at least, won't be that easy going forward.
Yeah, and it shouldn't be. I mean, in some sense, people shouldn't get complacent at all. So, therefore, pertinent point. In fact, during market hours as well, most people that I spoke to, listeners today, mentioned that it is good to take periodic profits off the table, and I think that is probably what Rahul was trying to indicate. I don't think his call is that go out and just blanket sell the market. It's just that it's going to become very difficult to make money here on. So be very selective. And maybe take some money off the table where it's very difficult to justify valuations, as he said. I'm not trying to put words in his mouth. I'm just trying to interpret what he was trying to say. Gurmeet, come in. You've got a bunch of clients. You manage portfolios as well. So a mixed hat that you wear, you and your firm. What is your sense? The long-term picture is yes, everybody knows is great. I'm trying to understand what to do in the short term.
So Neeraj, I think partially agree with what Rahul said. This is actually market being at all-time high. Probably a lot of portfolios are not at all-time high because even if you look at the index, maybe 50% of the Nifty and Sensex constituents are not close to the October 21 high. If you were to take that as, let's say, a benchmark for discussion point of view, because the IT stocks are down, pharma stocks are down, especially the API CDMO names. Some of the commodity producers are down. Even in automobile, we've seen some bit of pullback from the recent highs, including some of the large ones like M&M posted. And in general, I think because everybody was so cautious, the commentary was so negative, people weren't leveraged, weren't fully deployed in the market, and that's where probably I think the retail investors have actually done a fabulous job compared to FIs and even family offices and ultra HNIs, because they've kept it simple. And if you see, Neeraj, if you haven't done anything, if you've just done a SIP in Nifty 50, let's say, although I'm a PMS portfolio manager, but let me admit this, that had you only done an index fund, your 2-year returns, 3-year returns, 5-year returns, 6-year returns are all between 15 to 18%. So so I think what market teaches us is to keep it simple and not try and second guess it. I think what one has to be careful here, as Rahul said, because you are at 22, 23 times forward earnings, and going by the past, whenever the market is at 23, 24 forward earning band, the next 6 months returns can be suboptimal or maybe single digit. So you have to be where the earnings are. Have a balance sheet. It's like I said earlier in the day. When a batsman reaches a 50, 100, he takes fresh guard. That's what you need to, see where you are right now. Again, get a sense of where you are positioned, and go staggered. I think this timing aspect of I will put when the market goes down, I will keep a lot of cash. I don't think so. It works. It hasn't worked in the past. Don't think so. It's going to work in future.
And which is why the question, Gurmeet. So let's assume that you mentioned that you partially agree with Rahul, right? So my question is this: suppose कि आपने पैसे निकाले, you booked some profit in some stocks. क्या आप वो पैसे वापस लगा रहे हो market में, or are you kind of staying on the side because the valuations are so expensive? I'll tell you why, Gurmeet.
Sure.
We've heard this argument now since virtually 70,300, 400, right? From so many people that, things are looking bad, yields are rising, interest rates are rising, we'll go back, and the markets have surprised everybody.
Absolutely, Neeraj. And that's what I said. Had I told you last year that there will be a war, oil will be $120, Fed will hike 75 basis points thrice, and asked you to crystal gaze, you would have probably said 12,000 Nifty. And since everybody is bearish, the market, doesn't follow the popular narrative. And that's what been my learning is that it will never be a consensus call on the market. And since so many people are still cautious, that also tells you that probably the downside could be limited. Also, the flows which nobody talks about. I've been traveling in up country also. I think a lot of these domestic flows are secular and it should not be undermined. It was called dumb money, it was called whatever, that people are just trying to sell the India story and all. I think, and so my view is that you should invest cautiously. You should not try and time things and say that okay, I will maintain 30-40% cash. I think that can be very tricky in this market. And there are two aspects of taking a cash call. One is getting out, second is getting in. And cycles have shortened so much that you might just miss on the second leg, which is getting back in the market. At the same time, as I said, the fixed income yields have also turned positive. You get 7.5% for not doing anything by simply buying 3 or 5 year government bonds. So just balance it a little bit and see if the portfolio still has exuberance in terms of 70-80p stocks, or stocks where you probably thought that and correct your mistakes. I mean, if you've made some bad choices during IPOs, or just got carried away by some of the mid cap IT names or specialty chemicals, admit it and move on. I think that's another aspect. This business is as much about rejection as about selection.
Rahul, at a similar space that we had done a few weeks back, you had mentioned this power of retail money, right? The SIP flows, the domestic flows, and that being the differentiator for India vis-a-vis rest of the world. I hear you a lot more cautious right now. Is your caution on markets at large, or are you trying to say that hey, book profits but deploy it in some other value stocks? What is it that you are trying to convey?
No, so I think Neeraj, the year has. I mean, you can't exactly say two halves, but if you look at year to date up to say Diwali, FIs had sold about $35 billion cash this year, and domestics had bought about the similar number, and you were pretty much flat for the year, give or take. The interesting thing since Diwali is that FIs are positive about $2.5 billion, and DIs are virtually flattish in terms of their net cash purchase. So it's almost as if domestics were far more positive on the markets for the better part of this calendar year, but they're taking a slightly different stance from the Western money or the overseas money that's coming in. This is an interesting dichotomy that I was just observing, since Diwali, when they've almost pumped in about $2.5 billion. But as you rightly said, Neeraj, I don't think you're going to see massive redemptions or anything of that sort, because we did have a stage a few months back when the Nifty did fall from 18,000 to 15,000. But even at that point, you did see this discipline of money constantly coming in. The point I'm trying to make is, you may not get very significant absolute returns from here, but on a relative basis, as even Gurmeet was making the point, and I said in my first answer as well, there may be other options for you to get returns without doing too much, whether it's GSECs, whether it's fixed deposits, like I was saying a little earlier, and there could be some contra calls in commodities and the likes as well. So I don't think it's going to be as pure play in equity, year going into 2023. That being said, I think, the Gurmeet mentioned in his first answer to you that, IT, pharma, specialty chemicals, certain auto components, these are all export related sectors. So I'm not really surprised that these have actually underperformed. In fact, we've had an underweight on most of these sectors, specifically on IT, for quite some time. But I think going into 2023 as well, you're in a pre-election year. When you look at government spending, so you will have your domestic sectors like cement, banking, consumer do well, and I think that's probably going to be the trade. So there are always going to be stocks expensive. Even at a 7,500 Nifty, there will be stocks cheap even at an 18,500 Nifty. So I think it's just about finding that value. And as you rightly pointed out, I wasn't trying to say sell lock, stock, and barrel and go home. It was just, if you've made so much money. So just to put things in perspective, right, Neeraj? Since we were discussing IT, it's always what your vantage point is, where you want to look at it from. And let's take a case in point of Persistent Systems. That stock went up 6 or 7 times in the lockdown, in that phase. So even if the stock is down 50-60%, chances are at any point that you bought it, you are still remarkably in the money. So while it feels bad that it's off from the top, there's still a lot of money that's actually been made, and there's no harm taking profits if you're going to have a slowdown slash recession in the better part of the Western world. So I think there will be enough and more opportunities in domestic related sectors. I think the domestic money is fairly sticky, as we saw a few months back when the Nifty was at 15,000. So I don't expect a massive sell off of any kind. But the point I'm trying to make is, I would be surprised to see if this 18,000 became 20,000 next year. I would probably still think it would be range bound for the better part of the calendar year.
But Rahul, वही है कि you don't have Nifty futures in your portfolio. You have stocks in your portfolio, right? So my question is, let's try and boil it down. So आपने you mentioned Persistent, you mentioned IT services and the slowdown thereof. Our common friend Varinder put out that tweet, I think yesterday or day before, and we were talking about it just a day before that, about how, for example, some of the mid-cap IT stocks, I mean, a Persistent or whatever might still be expensive per se, but there are a bunch of stocks which are cheaper than PSU names as well. And we've spoken at length about how technology seems to be in a slightly longer term up cycle of sort, because the world is digitizing, etc., etc. So, are there pockets which have corrected significantly in 2022 which offer value, or IT is not a part of that?
No, so I think, Neeraj, see, there are two aspects to IT, right? One is the automation, digitization, the robotics part of it. And if you find that a lot of Indian companies over the last 4 or 5 years have actually made a lot of small ticket acquisitions in trying to buy out these capabilities rather than inherently create them. Right. I don't think that's a bad strategy. But I think if you still look at the bread and butter of Indian IT companies, it is still the conventional business. I think for most people, 60 to 70% of their business still comes from the US and Europe. And within that, you'd probably find that 35 to 55% is still coming in from BFSI. And the biggest challenge for any bank globally right now is deposit growth. So if you're going to have a situation where deposit rates are going to grow up and net interest margins are going to get compressed, and banks are not going to be able to pass through those costs, there's going to be a pressure on banking earnings. And in lieu of that, this total contract value that we optically look at, while those contracts will not get cancelled, they could potentially get deferred. And then with this issue of moonlighting, I have a sense that probably wage inflation may be a little higher, maybe by 2 or 3% than long-term averages. So if you have a situation where top-line growth is a bit, subdued, and margins also get compressed because your top line goes through, it's a simple numerator-denominator calculation. I'm not sure if that's the best bet right now.
Got it.
Neeraj, we haven't even hit the recession or the slowdown yet. We're just talking about it, right? It's one thing to talk about throwing the baby at the deep end of the pool. It's another for him or her to actually swim at that end of the pool. So all these rate hikes that have happened over the last 4 or 5 months, the economic impact of this is yet to be felt. And I think that itself might. So I do agree with you that it is structurally a very good sector. But my sense is, if you want to take an investment call on IT, that the time, according to me, is 6 to 9 months down the road. I agree with you that it's a great long-term story, but I think you will definitely get better prices as guidances, etc., get revised downwards. Right now, nobody's called out a down cycle, and you really don't buy IT companies for rupee depreciation. That's not a fundamental factor. So,
That's true.
I mean, that's just my limited point on the sector.
No, thanks, Rahul. Okay, and मैं आप लोगों को पूछूंगा कि आपके पोर्टफोलियो कॉल्स, सेक्टोरल कॉल्स वगैरह क्या है. बट गुरमीत, one question to you, जहाँ पे I think a lot of people are now either looking at it parked with interest or parked with their money. The last 2 months have belonged to PSUs and PSU banks. Uh, what is your sense, Gurmeet? क्या यहाँ से पैसा बनेगा?
Neeraj, I think you got to be selective here. What we have seen in the past, also, especially with PSU banks, is that even when they were recapitalized and we saw a huge rally, sometimes you can have sharp moves and you might enter at the wrong price. You should also not forget that 2024 would be elections and there could be government intervention as far as the retail, agri loan book, etc. is concerned. So you got to be careful that you again don't make the same mistake of only seeing credit growth, right? You have to still see who's having a better credit underwriting and responsible credit growth. I think the important aspect is also to look at how is the liability side shaping up, and I think that's extremely important, in my view. So if you look at SBI, for example, I've not seen a 1% ROA, 17% ROE, which we saw last quarter, for a long time. I saw their slippages only at 33 basis points. I saw the credit cost at around 50-60 basis points. They have about 3.5 lakhs of treasury maturing next year. Which will give them because now bank credit growth is outpacing deposit growth. So you need to have the firepower in your deposit base to take on this, right? Secondly, if you see SBI, 75% loans are MCLR and EBLR linked, where the reset is 3 to 6 months, which means the repricing will happen more in the second half, which will offset the deposit pressure and NIMs are likely to go further up. So I think you have to go level T. The point I was going that to on a bank balance sheet is that we should not just get carried away because all banks are doing well and make the same mistakes we have done in the past. Stick with people who are doing responsible credit growth in this cycle. SBI, by the way, 2003 to 7 outperformed every other bank, private sector bank in that. So I think selectively on PSUs, maybe a notch lower, maybe Bank of Baroda also, and but I would not just blanket by all PSUs just because the valuations are very reasonable.
No, actually, I'm asking the converse, Gurmeet. Would you go out and sell some of the PSU banks? Would you take profits off the table
No,
in some of those?
we just have SBI, Neeraj, fortunately in the portfolio, and there I don't see a need to, it's still 1.6, 1.7 book value, and as I said, I tweeted also earlier, I meet, SBI mutual fund is number one, SBI Life is the largest private insurer, they're doing very well in cards with 18% market share. It's a little early on my behalf, I think, but this group, I'm seeing some bit of culture change. You can't happen that all subsidiaries are number one and doing well, right? So there is a bit of a change happening. Hopefully it is more consistent and sustainable for our sake. I'm pretty constructive, but as I said, I'm not. Others we haven't touched and we would not like to touch.
Got it. Got it. Rahul, have you guys covered defense at all? Yeah, otherwise, I'll just avoid that sector completely.
No, Neeraj, still not officially tracking it, but after your event that we had recently, actually, we did host Paras and Bharat Forge and an ex-L&T defense personnel for institutional investors, and I actually found them sounding a little more bullish than they were at your event. So while we don't have official coverage, I think this, from whatever I'm hearing from managements and ex-employees of big companies, I think this could be a very serious theme to play out for the next half a decade or maybe even more.
Got it. But I won't put you in a dock, Rahul, by asking you about defense. Therefore, so let me ask you, Rahul. You have, I mean, you're probably the finest brains on all things consumption in India. Uh, Discretionary consumption, matlab McDonald's ho gaya, maybe some car companies, etc. All of them have had a good first half. PVR Inox starting to blow up, do well. But FMCG's kind of had a bit of a lull. I mean, HUL के results देख लो, कुछ भी, मतलब, they're not quite there. What is your sense on consumption? Where would you take money, or where would you take profits, or where would you book, or where you get out of some of those stocks? And where is it that you would stay invested?
No, so Neeraj, I think you've had a period where you've had time correction, price correction, and under ownership in consumer staples in India. And a lot of that money, and at the start of the lockdown, when Lever was close to 3,000, Britannia was going gung ho, Tata Consumer, all of that. And a lot of that, it started off with FMCG and pharma, and then it moved into other sectors like IT, etc. But my sense, Neeraj, is that as a third order impact, the first order impact being government spending, the second order impact being the people that will supply to them, like cement manufacturers, the third will be the laborers that actually get paid for doing the work. So if you are taking a call on rural coming up, because urban's doing really well, as you mentioned, consumer discretionary numbers have been really strong, hotels, multiplexes, QSRs. So if you have a turn in the rural side of the economy, that delta could be very significant, because for most FMCG companies in India, rural is anywhere between 30 to 60%, depending on which company you pick up. Interestingly, Neeraj, I happened to spend the entire day at Hindustan Lever recently when they did their first analyst day in 3 years, actually. And you'd be surprised to know, and this is, when we talk about technology, digital, and we look at, the Naikas and the Zomatos, you may be surprised to know that Lever actually gets 25% of its sales through digital and digitally assisted platforms today. And almost one third of their business is through premium products. Now, I'm not sure that that point is made very often or even appreciated. So my sense is this is not the time to sell consumption. I would actually say that this is a time to enter it, because if you get a slight delta in rural, and you're seeing that, I saw your interview that you did with Parley. I think it was sometime this week, if I'm not mistaken.
Yes, yes.
If you speak to Varun Berry, if you speak to Dabur, if you speak to Lever, they're all sounding fairly confident on the rural side of the business, and they're actually, with inflation coming off, uh, it's anyone's guess. And like I said, there are technical factors of under ownership, and you've had these stocks be market leaders, and they haven't done too much. So I would say that this is actually a time to be looking at them as opposed to be selling them. You've seen what's happened to banks. You've seen what's happened to cement. This is the only domestic story that really hasn't played out in a very material way in a very, very long time. And I think, look, Neeraj, I think there is no other sector in India that can give you return ratios of 70-80% plus on return on capital employed, return on equity, and return on invested capital. IT companies do have cash on the books, they have good dividend yields, they have good ROICs, but their ROEs and ROCs are probably half of the industry leaders in FMCG. So that's what you pay for. So I think, okay, just to put it in perspective, Neeraj, Hindustan Lever sales in the last decade, FY12 to FY22, compounded at only 9%, their top line. Their profits compounded at close to 17-18%. That's because their margins went up by 10%. That's the swing. So you actually just imagine if that 9% compounding went to as little as 11-12%. I'm not even talking about 15%. Just imagine the delta you will have on earnings. Then you will get back to a situation where people will be comfortable paying 50-55 times 1 year forward, which they are not today. So I think names like Britannia, Dabur, Lever, maybe even a Tata Consumer, with the kind of, I know their return ratios are very inferior to the rest of the pack, but just take a look at ITC. You had, a blowout because people found value in it, and just the right noises, and it's anyone's game. So I'd actually be incrementally positive in a pre-election year on consumer staples.
Okay. Thanks, Rahul. Rahul, can you? I mean, we'll end the space at 9:30. Can you hang on, or do you have to leave? In which case, I'll allow you to go.
No, totally fine. The next match is at 9:30. Neeraj, we're good.
Sounds like a plan. Actually, the one before which just ended was quite a match as well. But we'll talk football some other time. Gurmeet, one quick thought. And there are some requests for questions, but unfortunately, because there's so less time today, I may not be able to get people in to ask their questions for this space. So please excuse me for that. Gurmeet, auto and auto angs, what's your sense there? Because you understand that space really well amongst others. What's your sense there?
So, Neeraj, I think I continue to be very constructive on that space, because it's come out after possibly a 4 year lull. And so you got to be a little selective though, in terms of how you are positioned after the recent run up in prices. So, for example, in OEMs, we like M&M. I think if you see their last quarter, they were able to maintain their EBITDA margin at about 12%, which was actually pretty good, considering that there was promotional pricing on the lot of new SUVs, and tractor market has been fairly flat. We expect now their monthly capacity now to start expanding from almost 26-27,000 units to getting up to right up to 35-37,000 units. Huge order, and back to back 5 successful launches. In fact, the new Scorpio has added almost 1,25,000 to the bookings. Then you have the EV launch, so that I think should, and they haven't valued their EV properly. Much prudent capital asset allocation going forward, which the management has been highlighting. And I think the second half of the year, I agree with Rahul, could be better for rural with the winter harvest and government supporting it, which augur well for their farm equipment and the tractor segment. Uh, Continue to like Minda. I think the premiumization trend is continuing. They continue to add more kit value per car. They are EV ready in the portfolio. They will also possibly benefit with the 6 airbags coming next year, which actually expands the market by 3 times. So, as I said, multiple products being added, great at innovation, and we are selectively looking at some of the CV makers like Ashok Leyland or something, and maybe it's right now on the radar, but maybe we haven't taken a final plunge into it. So I think Indians are driving more. They are buying more houses, and that's I think is likely to continue unless interest rates become too restrictive. Which, in my view, I think inflation will surprise on the downside in couple of months.
Okay. Final question to both of you. Gurmeet, to you first. What is your top draw? It could well be banks. It could be something else. And do mention. I mean, the probable time horizon for this call as well. Where is it that you believe you will personally make the maximum money? And of course, risk adjusted returns.
Absolutely. I think Neeraj, you made the point on defense. I think we like that space very well. Defense manufacturing something is, yeah, we are tracking very closely. I think this could be, in fact, manufacturing in general, including electronics, chemicals, etc. Also textiles with FTS coming in now and PLI. I think will be a huge wealth creator this decade, and I say decade because I think it will be long term. Defense in particular, we got lucky with solar industries in our portfolio. Got in very early, and stock has really done well now, almost clocking 150-200 crores quarterly pat now. The yearly pat used to be 200 crores a couple of years back. Nice ship, both portfolios doing well, including the explosive as well as the defense order book. We are also tracking HAL. I think what I like about HAL was their EBITDA margin profile, because of the higher share of repairs and overhauls. In the overall revenue, which is a high revenue business. Great execution timeline in terms of 1 year, 3 year, 5 year deliveries on aircrafts as well as other lightweight helicopters and other spares. One of the largest order book in the defense space, still reasonable after the sharp rise we have seen there. And there are few small defense ancillaries which we are tracking. So these are the two themes we are personally very gung on. But as I said, I would stagger my uh, top line by deployment, because I think the market might just consolidate, maybe time correction, maybe a bit of price correction. So better idea is to stagger it, because as I said, I'm putting money for long term. But since we manage public money, we have to ensure that we navigate this volatility well.
The really interesting thing is, and I've just done a small piece on defense. The book to bill ratio, the traditional book to bill ratio, massive except for in Paras defense. Everything else, great order books, very good order pipeline. And there was an antique report that I was reading, Gurmeet, which said that the quantum of orders that have been given out in the last one month and ones which will come out over the next 3 months totaled up to some 9 lakh crores. I mean, just a massive number out there for the taking for Indians defense companies. And could be so maybe you mentioned some of it as well, but I'm just wondering, do you like the PSUs out here or do you like the privates here more in defense?
So Neeraj, there is enough for everyone, as I said.
Yeah, but still, I'm just trying to understand.
So I think both. As I said, I like HAL, I like Bharat Electronics. We are invested in solar. We've increased our weightage in the portfolio there. So it's a combination. And as I said, Neeraj, we have to look at the execution of the order book, which is the book to bill, right? So because you get an order now, the execution will take 6 years, 7 years, right? So you have to see the execution in the medium term and the long term both. So
Yeah.
for, let's say, HAL, we plotted Sukhoi delivery, lightweight helicopters delivery. What will be the revenue from repair and overall? And so you have to plot it so that there are no working capital issues
True.
and execution issues. Yeah.
Makes sense. Okay. Rahul, final question with you. Where is it again that you guys as a house believe will give the best risk adjusted returns from here on? Because we are at all time highs. And let's assume please give the horizon as well.
So I think, Neeraj, from a 1 year perspective, I think my probably biggest overweight call would be cement. And I think maybe in the large caps, Ultratech, and probably down the road, Nuvoco and JK Lakshmi. I think those would probably be the three names we would like to recommend in cement. When you ask me about defense, Solar Industries has actually been one of our biggest buy calls over the last 6 years. The reason I didn't pick it up is because, as Gurmeet pointed out, the defense book itself is a very, very small book. So I think I agree with him on that completely. And, there's a reason it commands those valuations with the return ratios and margins it has. But I think cement probably, Neeraj, and like I said, consumer will probably be a dark horse. But I think, Neeraj, if nothing goes wrong in execution from here, and this may be a slightly bold call that I'm making, because this company has only recently turned into profits and will start showing ROEs and ROCs only now. I think if McDonald's doesn't really mess up or goof up in their execution, this stock could still, I mean, I know it's gone up from about 250 to whatever, 750, 800 or thereabouts. I wouldn't be surprised if the stock even gives you a doubler from here, because I still think that the market cap is too low. The sales are too low for a franchise for the largest QSR company in the world. I mean, at over $30 billion of global sales, it just baffles me to see the kind of numbers on McDonald's that they're doing today. So I think if they don't mess up on execution or don't do anything wrong and capital allocation's all right, that could be another story. So I think cement from a 1 year perspective, and maybe if you want to stretch the horizon, I think some names in discretionary like Westlife could still end up doing reasonably well in your portfolios, I think.
Great. Gentlemen, thank you so much, both of you. The match is about to start, and we had anyways committed for half an hour, so we'll leave you on that. But really appreciate your time. Much, much appreciate.
Thank you so much.
Thanks, Neeraj. Always a pleasure. Thank you.
Yep. And everybody, thanks for tuning in. Markets all-time highs. Both are experts recommending, and a clutch of experts that I spoke to earlier in the day recommending that selectively some bit of profit booking is 100% warranted. Thanks for tuning in, everybody, and have a great week ahead.